Thank you. I'm delighted to be back with CII. Let's see. While the outlook is generally positive, certainly 2013 has proven to be a disappointing year for the global economy. We expect global growth to be 2.4% this year, essentially unchanged from last year, and very sluggish, in part due to the lingering impact of the global financial crisis of 2008-2009. Europe is still working through its sovereign debt problems. In the US, households are deleveraging. Around the world, governments are trying to withdraw the massive stimulus applied during the recession. So all of these factors have held back growth both in 2012 and 2013. In the United States, certainly this is a good example. This year we're seeing growth below 2% in large part due to fiscal policy headwinds, the tax increases imposed in January and some of the effects of budget sequester, which we expect will take about 0.5 percentage point off growth. The tax policies, another 0.5%. In the Eurozone, we see the long recession ending. The economy essentially stabilized in the second quarter, and growth will resume, but at a very modest pace in the second half. Meanwhile, China's growth is wavering. The new normal for China in the near term will be about 7% growth. Longer term, even slower than that. So the expectations that China might achieve 10% growth on a continuing basis were certainly overly optimistic. And I think all of our expectations have been revised downward somewhat. But ironically, we see developed countries, as opposed to emerging markets, driving the acceleration in the global economy in the year ahead. And that includes better performance out of economies such as Germany, the United Kingdom, Japan, and the United States. This chart shows global growth in blue, emerging markets in brown, and then the advanced countries in green. And overall, we see global growth picking up to about 3.4% next year and 4% by 2015. If you look at the decade ahead, we see average growth of about 3.5%. But the differential between growth in emerging markets and advanced economies will remain fairly large, with emerging market growth averaging about 5.5% over the next decade, and the advanced countries averaging only about 2% growth. So if you look at contributions to economic growth over the next decade, the emerging markets will account for about 55% of global growth. Now here's a look at growth by region of the world. And as you can see, the Asia-Pacific economies, excluding Japan, will enjoy the most vibrant growth. I'll go over region by region later on, but just for a quick summary, over the next decade, we see this group of countries growing at a pace of about 6%. Sub-Saharan Africa will be another region of strong growth. It's a small part of the overall global economy, but it is really the new frontier, and we see about 5.5% growth in that region over the next decade. Emerging Europe, Middle East, and North Africa, we'll see about 4% growth, as will Latin America. North America, certainly by the standards of the developed countries, will perform relatively well with 2.7% growth over the next decade. Western Europe, very sluggish growth, averaging about 1.5%. Japan, about 1%. Demography will be a restraining force in the Japanese economy with the workforce declining. Let me say a word about inflation. We've seen a retreat in commodity prices this year, and that in part reflects the slowdown in China. China has accounted for a disproportionate portion of the growth in overall commodity demand. China and other Asian economies, along with the Middle East. And the slowdown in China has been a major force. The continuing recession in Europe, another factor. But if you look at the dark blue line in this chart, it's our own IHS Industrial Materials Price Index. And if you look back at, the index is set to a value of 1 in 2002. And we saw an increase of about fourfold in that index in the 2002 to 2008 period. Then, of course, we had the recession, then a rebound, which brought essentially almost a full recovery. But that was really the super cycle in commodities. We don't expect that type of inflation in commodity prices moving forward, in part because supply growth has really caught up with and overtaken demand growth. And one area in which we see some moderation in prices is the oil market. Here, growth in global oil demand remains sluggish, and meanwhile production is rising in the United States, Canada, Iraq, Eurasia, South Sudan, and a number of other places of the world, including Brazil. So we expect that will lead to oil price declines in the year ahead. Right now, the market is inflated in part by a geopolitical risk premium, and certainly the instability in Egypt has elevated prices in the past month. But we see Brent, which currently trades at about $107 per barrel, moving down to an average of about $94 per barrel in 2014 and 2015. We think that will be the low point, but any escalation in the subsequent 5 to 10 years will be very modest. And I think another factor in the market is the convergence between Brent and WTI prices, which had been fully expected given the pipeline construction and redirection that essentially has alleviated the congestion in the mid-US continent. But the risks are clearly on the upside and reflect the security challenges in the Middle East and Africa. Overall, inflation will remain fairly muted worldwide. Global inflation around 3%, in countries such as the US, around 2%, in the emerging markets, a bit higher. And as you can see by this chart, inflation varies considerably region by region. If you look at the green bars, that's 2013 inflation. In Latin America, it's averaging about 7%. In the Middle East and North Africa, over 8%. But in Japan, we've still seen some deflation. We think that is ending now, and with significant increases in sales taxes in 2014 and 2015, Japan will probably hit its target of 2% inflation. And in Western Europe, inflation will be in the 1.5% to 2% range. So relatively slack resource utilization will keep inflation subdued. I think, it's 2013, kind of 5 years after the start of the Great Recession. One might be surprised that U.S. inflation is below 2%, and that core inflation is running at a rate of about 1.5%. And that, despite massive monetary accommodation, and that primarily reflects what's happening in labor markets. The employment cost index out today showed year-on-year growth in wages and benefits of only 1.9%. So real relative unit labor cost inflation is quite subdued. Let's move on to the U.S. economy. And here I think we're at the start of this favorable dynamic in which we're seeing improvement in consumer finances leading to more spending. That's creating jobs, generating income, and in turn driving spending. So we're seeing a virtuous cycle depicted by that loop of income, spending, and jobs. The positive forces reinforcing this cycle are job growth, running at about 200,000 jobs per month, rising asset prices, both home prices and stock prices. Household net worth has reached a record high, although if you account for inflation, it's still about 5.5% below the spectacular peak of 2007. The energy boom is another dynamic. It's creating jobs, creating a competitive advantage for the United States, driving investment. There's some negative forces, however, and a lot of those are policy related. Tax increases, the federal budget sequester, government regulations, and high debt burdens, both in terms of government debt and household debt. But household debt has declined significantly and will continue to moderate. Oops. So here's a look at the Real GDP Outlook, and I should note that today the government released its benchmark revisions to the GDP accounts, and this graph does not yet include those. But going forward, the story is essentially the same. We see growth picking up from a pace of about 1.5% in mid 2013 to 3% by the start of next year, driven largely by the easing of the fiscal contraction as well as the strong growth in housing markets. So if you look year by year, we'll see growth of about 1.7% this year, picking up to about 2.7% growth next year and 3.5% growth by 2015. One note on today's release, real GDP growth in the second quarter was only 1.7%. Year-on-year growth is 1.4%. So we're in that range that might be considered the stall speed, in which there clearly is a risk of the economy sliding back into recession, but we are confident that that will not happen. The fundamentals are fairly positive. Household finances in particular are strengthening, and capital spending is certainly on a positive growth path. The revisions also showed a somewhat milder recession. The peak to trough decline from late 2007 to mid 2009 is now 4.3% rather than 4.7%. The recovery since the trough is now 9% rather than 8.5%. So that's positive news. And I think the big change in the GDP accounts is the addition of a new component called intellectual property products. This has three components: software, which had been part of business equipment investment; research and development, which is new; and then entertainment, literary, and artistic originals. The two new components add about $350 billion to the level of GDP. In other words, raise the level by about 2.1%. And the base year has been changed from 2005 to 2009. Let me just go back. Our view is that the unemployment rate will hold fairly steady through the end of this year, And as a result, we do not expect to see the Fed begin to taper off on its quantitative easing asset purchases until early 2012. The unemployment rate hits the Fed's kind of target of 6.5% in mid-2015, so we see interest rates beginning to rise in late 2015 and then rising relatively sharply, with the Fed funds rate reaching 4% by the end of 2017, the 10-year bond yield reaching 4.5%, mortgage rates up in the 6.5% to 7% range. Long-term rates will rise ahead of the increase in the policy rate, however, and that will reflect the Fed tapering, and we expect by September of next year the end of all quantitative easing. But today's announcement really had no changes in policy, and the Federal Open Market Committee now views the growth pace as modest rather than moderate. That's clearly a downgrade. They acknowledge the risk from rising mortgage rates, and indeed I think they're somewhat disturbed by the extent to which interest rates have risen since their last meeting. And they've also included a statement recognizing that inflation is persistently below 2% could pose risks to economic performance. So clearly the Federal Reserve is backing away from the tapering talk of a month ago. And that kind of reinforces our view that tapering will not start in September, but will wait until early 2014. Now, one clear driving force in the pickup in the U.S. growth will be housing markets. I know it's probably not an important component of your construction activity, but it is an important driving force for the U.S. economy. Currently, housing starts are a little below the 1 million mark. Normal is about 1.6 million units, so we see normal happening by the end of 2015. That means from today until late 2015, we will see a 60% increase in residential housing construction. That's quite an impressive increase. However, once we hit 2015 and interest rates are rising more sharply, we will see a leveling off of activity. So we'll kind of go from very rapid growth to no growth. That will be quite an adjustment for markets. Overall, we see non-residential growth slowing down somewhat this year, in part to disappointing overall economic growth, and in part because we've already seen substantial gains in a number of sectors, including public utilities, oil and gas, drilling activity, for example. If you look at some of the industrial type investment in structures, this chart shows manufacturing, that dark blue line. We will see very strong growth over the next 5 years. A lot of that will be investment in chemical facilities to take advantage of our cost advantage in natural gas. We'll probably see some leveling off or decline in utility plant construction. And then with mines and wells, we see a bit of a cycle as prices remain volatile, but the overall level of activity will be quite strong. Moving on to other parts of the world, for Canada and Mexico, we see economic growth very tightly linked to that of the United States. In Canada, that's the brown line, you can see growth generally in the 2–2.5% range. Steady job gains will support consumer spending. We've seen a bit of a slowdown in non-residential construction, largely due to uncertainty about the global economy. Although we see oil prices moderating, we expect that they'll remain high enough to support continued development of the Canadian oil sands, leading to rising liquids production out of Canada. And Alberta and Saskatchewan will kind of lead Canada's near-term growth, reflecting investment certainly in the energy industry and in the case of Alberta. And let me just go back and say a word about Mexico, because Mexico is clearly on a steady growth path. We've seen a bit of a slowdown this year, but looking ahead, the outlook is certainly very positive. President Peña Nieto's agenda includes reforming education and labor markets, opening up the oil and gas industry to private investment, and increasing competition in some previously highly regulated industries like communications. So overall, we see more foreign direct investment flowing into the Mexican economies, particularly as concern about drug-related violence subsides a bit. And overall, that will lead to more robust growth. And certainly if you compare Mexico with Brazil, Mexico is a very cost-competitive economy and is a significant platform for exports to the U.S. economy. South America, varied investment climates, strength in countries like particularly Chile, Peru, Colombia, and to a certain extent Brazil, countries which are attracting significant inflows of foreign direct investment. In contrast, policy mismanagement and resource nationalism will restrain growth potential in countries like Venezuela, Argentina, Ecuador, and Bolivia. Let's take a look at the graph. Brazil is one country in which we've been edging down our forecast, particularly in the near term. But I think the positive is that we are beginning to see some recovery in fixed investment. It certainly is vulnerable to further increases in interest rates. The Selic rate has increased to 8.5%, relatively high, in an effort to restrain consumer price inflation, which has climbed above the top end of the central bank's target range of 6.5%. Also, supply bottlenecks due to strict local content requirements are delaying some development, notably in Brazil's offshore oil development. So, a number of forces: high and complex taxation, heavy bureaucracy, inadequate infrastructure, and increasing union activism will certainly hurt Brazil's international competitiveness. But given its resource base and its diversified economy and a fairly healthy consumer market, we see growth kind of moving up gradually to the 4.5% range. I won't spend a lot of time on the Western European economies, in part because our forecast remains very cautious. We've been kind of Eurozone pessimists. We've typically been on the low end of consensus for several years in terms of economic forecast, and even those have been maybe a bit too optimistic. But after 6 quarters of contraction, we believe the Eurozone economy stabilized this spring. Monetary stimulus, pent-up demand, and diminishing inflation will help to support an economic recovery. But it will be, there will clearly be a dichotomy between the northern and southern economies. Northern economies such as Germany, Ireland, and the Scandinavian countries will perform relatively well, while contractions in the southern periphery are likely to extend into 2014. One positive is that we're seeing significant progress in reducing fiscal deficits, and in some countries like Spain and Greece, reducing current account deficits as well. Labor costs have become more competitive, largely due to very slack labor markets, high unemployment, and some market reforms. But cost competitiveness certainly is improving in countries like Greece and Spain, much less so in Italy, unfortunately, or France. But gradually these structural reforms will help to improve the business environment on the periphery. So, but there remains kind of this vicious cycle due to the linkages between sovereign debt, the banks that have traditionally held that debt, and economic activity, which is affected by still relatively tight credit, particularly for small and medium-sized enterprises. The European Central Bank has managed the situation relatively well, providing ample liquidity, providing for bank recapitalization, notably in the case of Greece and Spain, sovereign debt relief, integrated banking regulation is probably the next step. So we had expected that Greece would be forced to exit the Eurozone. A few months ago, we changed that assumption. We now say that there's maybe only about a 40% chance of Greece exiting. So it's no longer part of our base forecast. But there still remains some vulnerability to flare-ups in the sovereign debt situation. And we see a significant spread between bond yields in countries such as Germany, the dark blue line, and Italy and Spain, Spain being the brown and Italy the light blue. And certainly with the tapering panic that we saw in June, we had a backup of yields. I should note that we expect that Spain will see kind of a provisional credit line from the European Stability Mechanism, allowing the European Central Bank to purchase Spanish sovereign bonds. That's why we do have a drop in Spain's sovereign bond yield in late 2014. But if you look at the growth outlook, you can see that we still have relatively weak prospects near term for Italy and Spain, somewhat better prospects for Germany. Maybe the star performer among the major European economies is the United Kingdom, and here we are seeing a very solid pickup in growth, and indeed we expect that the UK will move up towards 2% growth over the next few years. Emerging Europe is vulnerable to Eurozone problems, and here it's a mixed bag. Those economies most interrelated or most tied to Western Europe in terms of trading relations and finance are hit hardest, with the Czech Republic, Hungary, Slovenia, and Croatia being in recession. In Poland, growth momentum has slowed dramatically in the past 2 years. We've seen some weakness in construction activity, some fiscal tightening. We expect longer term Poland's outlook will be relatively favorable, and we should see some acceleration beginning in the second half of this year. Turkey will be another positive long term, but clearly there is some risk in the Turkey outlook. Social unrest has rattled financial markets. And Turkey is certainly vulnerable to any financial instability because it is running a significant current account deficit and depends on external financing. So here's a look. You can see that we expect kind of a good acceleration in the Turkish economy, as well as the Polish economy. and generally a better outlook for those economies that have been held back recently, some due to some political instability, including the Czech Republic, for example. Asia Pacific will be the leader in economic growth. The region has over half of the world's population and will be a major driver of economic growth. After a 2-year deceleration, we see the region's growth rate stabilizing this year and picking up a bit in 2014, 2015. The ASEAN countries will kind of have particularly strong performance led by Indonesia, Thailand, Malaysia, and the Philippines. Inflation remains subdued throughout most of the region. Notable exceptions are India, Pakistan, and Bangladesh, although in the case of India, wholesale price inflation has moderated significantly. Food price inflation will be coming down, so we expect that India's inflation rate will eventually subside, enabling some further reductions in interest rates by 2014. The medium outlook is bright, particularly for consumer spending, due to robust income growth, the emergence of middle-class populations, and deepening financial markets. So here's a look at performance country by country. You can see that relatively muted growth for Japan, stronger growth for China and India, solid continuing 6% growth for Indonesia, some pickup in growth in Taiwan, South Korea. Some of the countries that are very electronics intensive have experienced slowdowns recently. As that cycle turns, we'll see some pickup in countries like Singapore and Hong Kong, Malaysia. China's economic growth certainly has been disappointing. Growth was 7.5% year on year in the second quarter. We see some further deceleration in the second half of this year. One big concern is distress in the interbank financing market, including shadow finance. This will probably lead to a protracted period of deleveraging in China after a decade of very aggressive credit growth. If you look at credit across sectors of the Chinese economy, it's now roughly 200% of GDP. So clearly some deleveraging is called for. The Chinese leadership faces the tricky challenge of kind of containing or restraining, disciplining the growth in shadow finance without too much of a drag on economic growth. But I think China can handle this in part due to a fairly favorable financial situation. It has huge foreign exchange reserves, also a fairly strong federal government balance sheet. There is room for some modest fiscal stimulus. We'll probably see more of it in terms of infrastructure spending, more investment in low-cost housing to support growth. But clearly China's export-oriented growth model has reached its limits, and we see more dependence on consumer markets, which in turn will require kind of reforms and liberalization of the financial services sector. But here's a look at the long-term outlook. We see China's economic growth kind of decelerating down to the 5% range in the 2020s and the 4% range in the 2030s. So the new normal will be kind of decelerating growth in China. So, in the past forces driving China's growth included initially industrialization, the entry into the World Trade Organization, now the urbanization wave, and the next phase is kind of the upgrade of consumer markets. But this will clearly require continued reforms. Reforms really stalled during the last administration and hopefully will improve because that really is what's essential to improving the allocational efficiency of capital, labor, and other resources within the Chinese economy. Clearly, the movement is from rural to urban, coastal to western provinces, away from energy-intensive industries and up the value chain. So the strategic sectors that will be emphasized will be things like biotech, information technologies, high-tech equipment, new materials, new energy, maybe new energy-fueled vehicles. So bottom line, global construction activity is set to accelerate with the global economy picking up. This shows kind of growth in overall world construction activity adjusted for inflation. And you can see growth picking up to over close to 5% in 2014, 5.5% by 2015, and average in around 4% in 2016. So the peak year in terms of growth will be 2015. Certainly a driver of this is the residential sector. Infrastructure investment growth will be fairly steady, a little over 4%. Non-residential structure growth after a couple years of subdued growth will strengthen notably in the 2014-2015 period. So where will this be? The colored countries on this map are those for which we have a forecast in our global construction service. The red markets are the hot markets, the blue are the cool markets. Fortunately, we see more kind of red and pink in this map than blue. But clearly, Asian markets will be the main drivers of growth. North America will perform above average. Western Europe, notably below average. But the other emerging markets will generally have solid growth, and that includes Latin America, Africa, and parts of emerging Europe as well. So bottom line, a relatively soft global expansion this year, gaining momentum over the next couple of years. The US economy picking up to 3% growth by early 2014, 3.5% in 2015. The Eurozone continuing to struggle, but at least moving from contraction to expansion. In China, deleveraging, ushering in a kind of a period of relatively restrained growth, but it's still very respectable growth. Asia leading growth, but by historical standards, Latin America and Africa will do relatively well. So if you're looking for kind of new opportunities, those two regions are certainly places to look. Inflation and interest rates will remain low for another year, but there will be a period of significant upward adjustment probably in the 2015 to 2017 period. Today's rates are certainly far from normal. Normalization will take yields up, maybe 4 percentage points. But the good news is that global construction activity will accelerate. So I'll stop there and welcome some questions.
Yes, my question has to do with the change in leadership of the Fed from Bernanke to the favored candidate. What do you foresee will be the change perhaps in the policies going forward with that change in leadership?
Let me declare my own biases. Janet Yellen taught me graduate macroeconomics at Harvard University. I think one of her early appointments was Harvard before she moved on to Berkeley. And so I have the highest regard for Janet. And interestingly enough, two of my classmates were other candidates, Larry Summers and Roger Ferguson, a former vice chair of the Fed. So I think all three of those candidates would do very well. I also know Donald Cohn, who is another candidate. All four, the four leading candidates are stellar candidates in my view. They're probably considered dovish, but I'm relatively conservative, and I'm very comfortable with all of them. I think that they will take great concern to maintain the Fed's independence and credibility in fighting inflation. So I would say my personal preference would be Janet Yellen, but all of the leading candidates would do a very excellent job. Any other questions?
Hi. I just wanted to ask if you think that Keystone XL will ever be built.
I certainly hope so. I think it will. It's kind of disappointing. The current administration seems to be delaying, and maybe that's its policy. Avoid going ahead with the pipeline by delay. So I hope it does. Certainly there are strong reasons for it to go ahead. We want the supply from Canada's, certainly for energy security. I think the development of an integrated North American energy market is to everyone's advantage. So common sense suggests we should go ahead, and I think common sense will prevail sooner or later.
Yes, I have a question. You made a comment about negative headwinds around the debt burden, but what's your sense of municipal, state, federal burden and the impact on infrastructure investments?
Well, we have a very guarded outlook for state and local infrastructure investment in the U.S. But the good news is that revenue growth is picking up. Some of that relates to capital gains. The tax changes triggered a lot of capital gains being taken in late 2012. So some of the improvement in tax revenues is temporary, but overall economic growth will be accelerating, and I think that will bring further improvement in state and local finances and eventually lead to a stronger outlook for construction. But, unlike in some past eras of, like the Interstate Highway Program, the federal government will not be a significant funder, and I am very concerned about the chronic federal budget deficits. Certainly the increasing commitments under the Affordable Care Act means that it will be very difficult to close the federal deficit. It could widen after 2014 without agreement on some significant fiscal adjustments. So certainly the outlook is rather pessimistic for any federally funded infrastructure, but at least for states and localities, I think the outlook is improving, and I would not generalize the Detroit situation or some of the problems we've seen in municipalities in California or other parts of the nation. Yes, pensions, the pension burden is significant, but I think it is manageable. The outlook will improve.
Any comment on the possibility of a European-U.S. trade agreement?
Yes, I think that there's a strong possibility of a trade agreement. Right now is probably a good environment to get those talks going, in part because Europe needs some engines of economic growth, and this would be one of them. Europe, it's certainly in Europe's best interest from a number of perspectives. It's in the best interest of the U.S. Generally, I think that largely as a result of our energy policy, the U.S. will become more competitive vis-a-vis Europe. But Europe certainly would benefit from opening up more of its markets. Generally, the countries that are successful in Europe are those that are strong exporters, Germany being a good example. So yeah, I think there is a good probability.
I wanted to get your opinion on the viability or the possibility of LNG exports. There seems to be two schools of thought, whether that's a good thing or a bad thing long-term for the U.S. economy.
Well, I'm bound to disappoint one side by answering, but economists tend to be free traders, and I think free trade is the way to go. LNG exports will generally be good for the economy. Without them, I think the risk is that with a kind of an emerging natural gas surplus, we would see depressed prices choking off development of further resources with very negative impacts. So we essentially need this export outlook to maintain a price level that will kind of support investments in our natural gas resources for the long term. I don't expect that we'll be a huge exporter of LNG, but certainly the projects that are going forward will be a plus for the economy, and we'll probably see some more.
One question in regards to your outlook on Latin America. You showed that the current economic conditions for Argentina and Venezuela are not favorable at the time, and Colombia actually favorable. But then on 2016 and forward, there is a change, and you do have a more positive outlook on Venezuela and Argentina. I just wanted to know what are the main assumptions for that outlook?
Well, certainly in the case of Argentina, it's a rich resource base. In the case of Venezuela, near-term politics are holding back economic development. I think our outlook probably requires some modest shifting in the political environment to attain growth rates in the 4 to 5% range. But there is some slack in those economies, and I think they'll also just benefit from strengthening trade relations with Asia, more trade agreement, more trade liberalization, hopefully. Hopefully this trend towards local content requirements by Argentina and Brazil and others will be reversed at some point. But yeah, I think you did identify a risk to our outlook, and certainly the status quo would not be terribly acceptable.
Yes, my question is to do with the U.S. dollar and its role in the world economy. Do you see a significant shift in the way the dollar is being used, for trade? And if so, what's going to be the impact to the United States and the United States economy?
I do not see a significant shift. Ever since the euro came into existence, there have been kind of predictions that of the decline in the dollar. If you look at the dollar's role as a reserve currency, there's been very little diminution, still maybe 60% of foreign currency reserves of central banks. So it hasn't happened, and I don't see any strong reason for it to happen in the future. China simply doesn't have the deep financial market that would be necessary to make the renminbi a reserve currency, for example. Europe doesn't have the vibrant growth prospects. So the dollar will probably maintain its position. And I think the dollar will be relatively stable in the next few years. It will probably appreciate a bit near term. And then kind of depending on the evolution of our current account balance, I guess the next step would be what happens as our trade balance improves. That could lead to some strengthening. On the other hand, it might take some further dollar depreciation to bring about a significant improvement in or significant reduction in our current account deficit. But we do see reductions in oil imports making a significant dent in the trade deficit. The problem is kind of the legacy of large deficits means that will increasingly paying income to foreigners on assets held abroad.
One more question? No more? Okay. Sarah, thank you.